Since this problem is so large and so long, I'm choosing to break the video up into two sections. So this first video here will walk you through the first two requirements that are listed here. We'll create the T accounts, and then we'll walk through each of the journal entries for the transactions that are stated above here. So a couple of things. I did this in Excel. The first thing I'm asking us to do is to create all the T accounts, and this is a good habit for you to get into because it forces you to visually see what goes on behind the scenes in the accounts as we journalize each of these transactions. So we have to create a T account for all the items listed in the stockholders equity section of the balance sheet, all four of these accounts. And I'm also asking us to prepare T accounts for these accounts here, paid in capital and from treasury stock, the stock dividends, distributable, because we're going to use these as we work through the transaction. So I've kind of done this ahead of time. You'll see here that I've created a T account for each of the 8 accounts listed in the problem. And a couple things I'll just point out here real quick. I'm not going to spend much time on this, but I've noted next to each account name whether it's an equity account or a contra equity account, and you'll notice that by the signs here where the normal balance is, that the equity account, which I've listed down here, a normal equity account has a normal balance on the credit side of the account. So all the equity accounts would increase on the credit side, and of course a contra equity account will increase on the debit side because it's contrary to what the normal rules of the equity account are. So I've listed all these accounts here, and you would then need to go back and first pull off the beginning balances of all these accounts. So we had 3.2 million in the common stock account, so I would go back here and I would put 3.2 million, and notice that's a positive amount. Hold on one second, let me just fix this. Okay, so you'll see that $3,200,000 is the beginning balance in the common stockholders equity account on the first date of January 1st. On January 1st of 2016, that's the opening balance. These are permanent accounts, balance sheet accounts. I'd go next to the paid in capital in excess of stated value for the common stock, and I'd have $600,000 in there. And again, we'd put it on the normal balance side. Okay, and then I'd keep going through all the other accounts. I'm not going to flip back and forth here. You can have the sheet in front of you if you want to make sure my numbers are correct. It's $7,100,000 for the retained earnings. And then we had some treasury stock, and notice treasury stock is a contra equity account, so I would actually put it on the normal balance side of the debit. So we would have $240,000. So that's all that you're required to do for the first requirement. Fairly simple. And so now we're going to walk through each one of these journal entries for each of these transactions, and this will be fairly time consuming. I'm probably not going to be flipping back and forth here. You can do that as you watch the video. I'm just trying to save a little bit of time. So we'll start with this first transaction on January 7th that says we paid the cash dividends of 18 cents a share on the common stock for a dividend that had been properly recorded on November 30th of the preceding year for $66,600. So what's not shown here, this isn't a complete balance sheet, but you would have a liability showing that you owe your common stockholders a dividend, a cash dividend that you promised to give them in a prior accounting period, which would have been 2015. So if you could see the liability section, you'd see an outstanding balance of $66,600 of a stock cash dividend payable. So for the first entry on January 7th, we're going to go ahead and pay that amount. And so what we're going to do is decrease a payable, and to decrease a payable you have to debit that payable, so cash dividends payable, and I'm also going to pay the cash, so I'd credit cash for the $66,600, and the cash dividends payable would decrease by $66,600. $600. So that's the first entry, and if you wanted to post these to the T accounts right away, you could. Again, we're only going to post them to the T accounts listed in the problem, so not to the cash account. I only care about the equity accounts. So this cash dividend payable account, $66,600, would go down here. Since we debited that account for $66,600, I'd put a debit there. Okay, so we would do that as we keep going through each of these entries. The next entry, and you can refer back to your sheet, was on February 9th. We were told that we issued 50,000 shares of common stock. And hopefully by now, I don't have to show you a picture of the transaction. What happens when we issue common stock is we receive cash, and in exchange we issue common stock. And we would take the cash as we would calculate the cash rather as being the number of shares, which is 50,000 in this case. Well, they don't tell us the price per share, so I don't have to do that. They tell me it's for $600,000. So I would debit cash for $600,000, but I don't credit common stock for that entire amount. And the reason for that, again, is because I have a common stock that has a par value, or a stated value in this case, of $8 a share. So I'm going to take that 50,000 shares times the $8, and when I do that, that tells me how much money goes into the common stock account. So 50,000 shares times $8, 400 grand. The remaining 200 goes to paid in capital in excess of the stated value for the common stock. And again, at this point, you could go ahead and post the journal entry to the T accounts. You would credit the common stock for 400,000. Credit the common stock right here for 400,000, and the difference, the paid in capital in excess of stated value, would go right here. I gotta add enough zeros. I think I didn't put enough zeros here. Debits have to equal credits, right? Okay, so that's February 9th. We'll just keep moving through. On May 21st, what happened was we sold all the treasury shares that we had outstanding. And so I'm going to actually pull the problem back here so you can see real quick. The treasury shares, we had a balance in the treasury stock account of 240, meaning we only paid 240,000 for these 30,000 shares, but when we sold them, we got more than what we initially paid for those treasury shares. So we're going to sell all of them. That account should then logically be reduced to zero. So we'll credit that account for 240. We'll debit cash for the entire 300,000. We'll credit treasury stock for the 240. But then you might be wondering, well, what do we do with the difference? And we've seen a problem like this already in the prior homework, where that difference goes to paid in capital from the sale of treasury stock. So again, we'll post those two accounts. 240 to the treasury stock means now that logically that account has been wiped to zero, and the paid in capital from the sale of treasury stock, we get the remaining what was it, $60,000. Okay. Go back here. We'll keep moving our way through all the transactions. On July 1st, the company declares a 4% stock dividend. Now here you got to be kind of careful. Okay, so we're not paying anything, but we're going to be issuing stock, 4% more stock, and it's going to be distributed on December 15th. Let me just pull this back up, because we're going to have to figure out 4% of what? It's 4% of all the stock that is outstanding when they declare the stock dividend. So how many shares are outstanding? And we can remember that outstanding equals issued minus treasury shares. So we issued originally on January 1st, we had 400,000 issued, and then we had 30,000 in treasury. So we had 370 outstanding, but we subsequently issued another 50,000. So actually what I'm going to do, because this will come in handy later, is I'm going to keep track of the common stock shares outstanding, because this will help us later. And so I would say, you know, maybe at the beginning of the year, outstanding, and you can go back and review, that was 370,000, because we had some shares of treasury stock outstanding, or that we held. Let me just format this, it's bothering me. And so subsequently we issued more shares right here on February 9th, and this, remember, is number of shares, not dollars. So 50,000 shares were issued, and so now our outstanding amount, so the outstanding amount at this point on February 9th, if I could get the formula right, is 420,000. But on May 21st, the treasury shares we held, we sold them back to the general public. So that increased the number of shares by 30,000. If you're wondering where I got the 30,000 from, you'd have to refer back to here. There were 30,000 shares sitting in the treasury, and I sold them back to the common stockholders. So that's where I got the 30,000. So my running total as of July 1st, the balance is all of this, right? The beginning balance plus the amount I issued plus the treasury shares. So 450,000 shares are the, and that's, again, that's important, that's relevant, because I'm issuing this stock dividend, and I better make sure I issue it to all of the outstanding shareholders. I can't discriminate here. I got to give them to everybody. So if you own 100 shares on this date, you would be promised an additional 4 shares in the future. It will be given to you on December 15th of the following year. Okay, so 450,000, if I take 4% of that, is 18,000 shares. So I'm, at this point on July 1st, I'm promising that I'll distribute an additional 18,000 shares on December 15th of the following year. Now, that is a significant transaction that does certainly affect the balance sheet. And so we haven't really talked, well, we did talk about a stock dividend. And so here's what happens when we have a stock dividend that we actually declare. We debit this stock dividend account, and you take that by the dollar amount is the number of shares times the market price on the date of the stock declaration. And so that's $13. They're telling us that right here, $13 a share. Okay, so times 13. So $234,000. Now that stock hasn't been given yet to the shareholders, so I can't go ahead and increase my common stock account. I have a stock, an account called a stock dividend distributable account, which is a contra equity account, and that amount is going to be the number of shares times, in this case, the stated value. So the 18,000 shares, and the stated value in this case is $8 a share. So the difference at this point gets issued right away to paid-in capital in excess of stated value for the common stock. And that's the difference between these two. Debits have to equal credits. Now that's a very confusing transaction. I want you to go back and just kind of think about what logically happened here. We promised to give this out at some point in the future, the stock dividend. And so you, just like when we have a cash dividend, we take that out of retained earnings, and in this case it goes to the stock dividend account, which will be closed to retained earnings at some point, so it'll remove the amount from retained earnings, but we don't give it out yet, so it sits off to the side on the equity section, and it says, well, we know we've got something coming down the pipeline. It hasn't been distributed yet. It'll be distributable, and so let's just kind of park it there. So that's what happens on July 1st. On September 30th, the next transaction, the problem says that we purchased 10,000 shares of treasury stock. Fairly simple transaction relative to the last one. Treasury stock, and we paid $100,000 for it. So our cash goes down by $100,000. It might be bothering you that I didn't post these transactions to the T account, so why don't we go ahead and go back and do that. I think I left off at the 240 and the 60. Yep, I got the 60 and the 240. So we would actually have to take then, this is a the 234 goes to the stock dividend account, 234. Okay, and we would take this 144, the stock dividend distributable, put it there, and we take the $90,000 of paid-in capital in excess of the stated value. So I think that was 90,000. Okay, there I've posted that one. And then the $100,000 goes to the treasury stock. So again, we have a balance in that account. We're not posting the cash transaction. We can move on to the next transaction, which happens on December 15th. Okay, So on December 15th, and you're wondering, why am I picking December 15th? It's not a transaction listed on here. Well, yeah, it is. It's kind of hidden right here. So what's happening is we're actually going and distributing those shares, and that was the shares from right here. We're distributing them to the shareholders. So we're going to remove the stock dividend distributable account. It's going to be issued to common stock, and that would be for this amount of 144. We didn't do anything with the paid-in capital in excess of the stated value because it's already there. It was put right into that account when we declared the stock. So this 144, I'll post these to the T accounts, goes into common stock, comes out of here. Okay, this account is now 0, and we've got the right amount in the common stock account. December 27th is the next transaction. And on December 27th, we declare a 20-cent per share dividend on all the common stock. Okay, so we actually declare, so we would have a cash dividend as one of the accounts and a cash dividend payable. Those are the two accounts. This is a liability account. This is a contra equity account. So we have to know how many shares are outstanding at this point because each one gets promised 20 cents. So we knew that when we declared the stock dividend back here, there were 450,000 shares outstanding, and then we promised another 18,000. But so if we start at 450, we can't add the 18,000 yet because they didn't get distributed or actually given until the 15th. So I do have to actually add that on 12/15, the 18,000 shares, but I repurchased some of these treasury, the treasury stock. So there are 10,000 shares negative. So the total shares that actually get some of the stock dividend, or sorry, cash dividend is 458,000 because remember we don't pay cash dividend to the treasury shares. So 458,000 shares times 20 cents. So I should make sure I post this right away. So to the cash dividend account is 91,600. I think I forgot one of the entries here. Let me just double check. I screwed something up. I'm sorry about that. This $66,600, this is a liability account. It doesn't go to the equity section, so when I put it in here I was wrong because this doesn't say cash dividends payable. Sorry. We would have caught that eventually, I think. Okay, so that's the December 27th transaction. Lastly, I ask us to close the credit balance in an income summary account. So on 12/31, we're told that we have an account called, and this was the closing process you learned way back in Accounting 201. We said that the credit side of this has a credit balance of 485. And if you remember, that's a good thing. That means we had a profit. And as the accounting cycle goes, we close the income summary to retained earnings. That's the profit that the shareholders have the right to, and we dump it into the retained earnings bucket. And so this account has to be zeroed out. It's a temporary account. We would debit income summary for 485, and we would credit retained earnings. And by crediting retained earnings, we're increasing the retained earnings account, and so it's gone up in value, and that shows a positive amount for the shareholders. So that's what we do on December 31st. And then lastly, I know it's very long, we close the two dividend accounts to retained earnings. But before I do that, let me make sure I post this 485 to retained earnings. See, it goes up. And I close, so when I close the two dividend accounts, that's this one and this one, they get closed out at the end of every accounting period because they're temporary accounts. So I'm going to credit stock dividends for 234, and I'm going to credit cash dividends for 91,600, and they'll be zeroed out. They'll have a zero balance, and that difference gets dumped into retained earnings. So when I pay a dividend, whether it's stock or a cash dividend, it's actually coming out of retained earnings. That's how we're paying them back. They're actually getting distributions, and it's coming out of retained earnings. So the offsetting account will be retained earnings for the 325,600. So I did the journal entry kind of backwards here. I'm going to, on December 31st, I'm going to credit retained earnings for whatever that amount was. I can't remember, but I know we have a cash dividend account and a stock dividend account, and those two were going to be the stock dividend was 234 and this one was 91,600, so the balance went here. Okay, that's it for the first two requirements of the problem. I'm sorry it took so long, but I think that's probably the hardest part of the problem.